The market right now is an absolute circus. Every positive headline, every Trump Truth social post, and you've suddenly got all these exciting green candles lighting up all over your screen. They're screaming at you, get in. If you don't get in now, you're going to miss it. And then you get in, and then minutes later or hours later, you're crushed, gone. Back to where you started, or maybe even worse. Your brain loves these green candles. Mine does too. It's that dopamine hit. And it will get you killed if you're a swing trader if you're not careful. So right now, we wait. We look for confirmation, not excitement. We need that confirmation. When I started this channel, the plan was simple. Share my trades, share my setups, the real ones, the ones that I actually believe in, the ones that are going to make me a profit. But with all this noise, I'm not just going to pick random nonsense just to keep the videos consistent. I'm not going to promote trades that I don't believe in just to fill a content schedule. You'll see plenty of that on YouTube, but that's not what this is about. Right now, energy and oil are dominating. Yes, there's volatility. Yes, there's movement, but for a swing trader, that kind of unpredictability isn't the opportunity for me. It's a minefield. It's a day trader's dream, but it's not mine. You might spot some excitement in individual stocks here and there, but honestly, most of it is just noise. Noise that fades with the next tweet. Now you're going to notice something about this channel as you follow along. I don't stick to one lane. Sometimes I'm a swing trader, hunting for momentum. Sometimes I'm sat on my hands doing absolutely nothing. Sometimes I'm thinking more like a long-term investor, quietly building a position. Markets change, conditions change. The playbook that works in a trending bull market is not the same one you want in the middle of geopolitical chaos like we're in at the moment. So I adapt. I think you need to. I once heard a well-respected financial influencer say, you can't be a trader and an investor at the same time. Why not? Seriously, why? As long as we stay disciplined and we know the subject, I think we can diverse into all areas of the market. Because from where I'm sitting, being able to shift gears depending on what the market is actually doing isn't a weakness. It's the whole point. The ones who get hurt are the ones who keep swinging when there's nothing to swing at, or the ones who panic sell long-term holdings because they're thinking more like a day trader. Know what you're holding. Know why you're holding it. Know which hat you're wearing at any given moment. That's it. That's the whole secret. So what do we actually do right now? We change direction for a bit. We use this chaos productively, because here's the thing. I'm not just a swing trader. I also hold an ISA. If you don't know what an ISA is, an ISA is an individual savings account. It's a tax-efficient wrapper available to UK investors. Any gains you make inside of it, capital gains, dividends, they're all completely free from UK tax. You get an annual allowance of £20,000. It's one of the best tools a UK retail investor has, and if you're not using it, you really should look into it. If you have a look in the description, you'll see where I am holding my ISA at the moment. Click the link, have a look. But there's plenty of places out there. Do your own research, see what platform works for you. Inside my ISA, I hold long-term positions. These aren't swing trades. These are companies I've researched, I believe in, and I'm happy to hold through noise, through volatility, through black swan events, through whatever gets posted at 3 o'clock in the morning on Donald Trump's Truth Social. Here's something that doesn't get talked about enough right now. The UK stock market, I think, is cheap. Genuinely cheap. Especially in the small cap space. UK equities have been out of favour with global investors for years. Post-Brexit uncertainty, slower growth, the US market stealing all the attention, and that's created something interesting. a market full of fundamentally solid companies, trading at valuations that are increasingly hard to ignore. We're talking about lower price to earnings ratios compared to the US equivalents, decent dividend yields, businesses with real revenue, real profits and real history, quietly compounding away while everyone's eyes are glued on the Nasdaq. This isn't me saying piling right now. I'm saying now might be the time to get deep and dirty into that watch list. Do the research, build the conviction, so that when the dust settles, and it always settles, you're all ready to move with purpose, not panic. If you're already invested and you're feeling really nervous at the moment, that's completely normal. This is a black swan event, and history shows us that selling into this kind of fear is often one of the worst decisions you can make. I've lived through many of these events now. They feel different every time. They always feel like this one is the one that's not going to recover. It always recovers. Listen, this is not financial advice. These are just some of the honest thoughts of someone who trades and invests for real, who's made the mistakes in the past, selling at COVID lows. When the swing trading setups come, and they will, I'll be here ready. Until then, we sharpen the watch list. I'm at my trading desk daily. I'm looking for opportunities to extract money from the markets. And I've seen one of these companies that have been on my watch list for a while, Volex. It gave us a trading update. We always talk about the picks and the shovels, the idea of investing in companies behind the big trends, rather than the trends themselves. The boring companies, the ones that you don't get on YouTube thumbnails. A few years ago, I was following a well-known UK stock investor on social media. He was doing a video on the big names at the time, you know, in the EV space, data center space, the household names, the ones you get all the views and the clicks. I dropped a comment mentioning Volex and the potential I thought it had. A couple of minutes later, I noticed that he'd deleted it. Since that day, the stock is up 93%. So today I want to talk about Volex. Ticker VLX. As I said, this week they dropped an RNS and the stock jumped 12% before most people had finished their coffee. And I want to explain why that doesn't surprise me at all. And more importantly, why I think the story is far from over. So the first thing, what does Volex do? Well, Volex is a specialist manufacturer of power cables and high-speed data transmission products. They make cables, connectors that power and connect the world's most critical infrastructure, data centers, electric vehicles, medical equipment, industrial machinery and consumer electronics, you know, like your kettles and stuff. I know, cables. Not exactly the stuff of that gets the likes on YouTube and stuff, but this channel's not about that, as I said. Here's the thing, nobody builds these hyperscaler AI data centers without cables. Nobody rolls out an EV charging network without cables. Volex sits at the physical infrastructure layer of every major technology trend happening right now, and that is exactly where I want to be invested. They operate 23 advanced manufacturing facilities across 25 countries. They employ over 13,000 people. Revenue is expected to hit at least $1.2 billion this year, ending in March. That's a 77% increase in 3 years. Now, you can't talk about Volex without talking about the man running it, Nat Rothschild, Lord Rothschild, to give him his full title. Nat joined Volex in 2015, and he has been the driving force behind this transformation. And here's what matters to me as an investor. He owns roughly 25% of the company through his investment vehicle, NR Holdings. This is not a founder's legacy stake that's just sat there. He's built that position and he keeps adding to it. As recently as mid-March 2026, his trust was still buying shares in the open market at around 430 pence. The man is putting his own money on the table at prices not far off where we are today. That is skin in the game, proper skin in the game. And the name, Rothschild, look, I know it sounds like a cheap observation, but But a name like Rothschild opens doors in boardrooms, securing contracts with the world's largest technology automotive companies. That matters. In my opinion, it's helped Volex punch well above its weight for an AIM-listed manufacturer. You don't land Tesla contracts by accident. Back in 2022, Rothschild set out a bold 5-year plan. $1.2 billion in revenue by the end of 2027, with an operating margin of 9 to 10%. The market raised an eyebrow, City analysts were sceptical, but he's delivered it. Not only that, he's delivered it a year early. It's not a near miss, not as an on-track statement, it's delivered with margins running above the top end of the target range. That's not luck, that's execution. I've watched Volex navigate things that would have flawed other lesser companies. COVID, global supply chain chaos, the semiconductor shortage, war in Europe, energy prices spiking, copper price volatility, and all through it, this company has kept growing, margins up, margins resilient, strategy intact. So I noticed in this week's update, it flagged that Volex has minimal direct exposure to the Middle East, which is worth noting given the current geopolitical tensions. And honestly, the resilience goes deeper than any single region. The reason Volex keeps its head above water when the world is falling apart is its geography. They don't sit in one country and ship globally and hope for the best. They've built a distributed manufacturing footprint. Facilities in Asia, Europe, India, Turkey, Mexico, Indonesia, all positioned close to their customers. When supply chains get disrupted, Volex can flex. When a customer needs to nearshore their manufacturing to reduce tariff exposure, Volex is already there. This local for local model isn't a line in an annual report, it's the reason they keep winning business when their competitors are scrambling. They've also invested heavily in vertical integration, meaning they control more of their own supply chain. They make the specialist cable used in EV charging products in-house. It's a margin story and a resilience story rolled into one. One thing I wanted to verify before making this video, can Volex actually pass on commodity price increases or do they just eat them? Because copper is one of the biggest input costs here and copper moves around a lot. And I found the answer, confirmed in their own 2025 financial year results documentation, is yes, they can. They have real pricing power. Not the flashy kinds you get with a brand like Apple, but the structural kind that comes from being embedded in your own customers' operations. That's difficult to replace. Volex isn't selling a commodity, they're selling precision manufactured, safety certified connectivity products into markets where failure is not an option. That changes the negotiating dynamic considerably. Now let's talk about how the story has evolved, because this is quite important. When I first started following Volex, the exciting narrative was EVs, electric vehicles. Tesla was the name everybody wanted to hear about. Volex became a licensed manufacturing partner for Tesla's North American charging standard connector. But the story has shifted, not away from EVs. That segment is still growing and the contracts are still there, but the new engine is the data centers. This year, Volex's data center revenues are roughly expected to double to $118 million. Doubling in 1 year, driven by surging demand for high-speed data transmission products from the companies building out this AI infrastructure at breakneck speed. And the broader picture is staggering. Industry forecasts point to nearly 100 gigawatts of new data center capacity being built between now and 2030, effectively doubling global capacity, with a total investment potential reaching into trillions over the same period. Every single one of these facilities needs power cables and data transmission products. Volex is sitting at the physical infrastructure layer of it all, and it's well placed to keep on winning. There's also a structural shift coming that most people haven't even looked at yet. Right now, AI is still in the training phase, building models. But from 2027, the weight is expected to shift to inference. Actually running models at scale, billions of times a day for billions of users. Training is lumpy and one-off. Inference is ongoing, recurring, structural demand. The infrastructure supporting it doesn't switch off. And for a business like Volex, this is very important. Now, this is important, and I want to give you a proper picture of how revenue breaks down, because when people hear data center revenues doubling, they sometimes assume that that's the whole business. It isn't. Based on 2025 results, here's roughly how the 1.87 billion revenue split out. Consumer electricals is 24% of the business. Complex industrial technology, which includes the data centers, is about 22%. Medicals around 15%, EVs around 16%, and the rest, well, just making up the balance. This revenue shows strength, not weakness. 5 different end markets, all growing with their own independent tailwinds. If one has a bad year, the others carry the load. That's real diversification, and it's one of the reasons this business keeps on delivering through whatever the world throws at it. And it's not just the CEO with skin in the game. The company operations officer, John Malloy, also bought 31,620 shares on the open market. When people running the company are spending their own money on the stock, not receiving options, actually buying, that tells you something about how they see the next few years. And on the institutional side, Volex is well supported. Around 60% of the company is held by institutions. These are not hot money or momentum chasers. These are long-term, fundamental driven owners. Retail investors hold around 14%. The point is, there's a solid base of serious, patient money already in the stock. So, what are we watching right now? Mark this date for your calendar, 22nd of April 2026. Volex is hosting a Capital Markets Day in London, where they're going to set out an entirely new set of medium growth targets. Here's the context that makes this significant. The old 5-year plan, set back in 2022, was 1.2 billion revenue by 2027. As I said, they've hit that a year early. So what they're going to announce next time in one of the hottest sectors in global technology. What is the new number? 1.5 billion? 2 billion? The size and ambition of that answer will move the stock. The board is currently consulting major shareholders on moving from AIM to the main market of the London Stock Exchange. If that happens, Volex could become eligible for the FTSE 250 inclusion, which would broaden shareholder base significantly. It will attract index-related demand from funds that currently can't or don't hold AIM stocks. That's a meaningful re-rating catalyst. Here at Omara, I'm always trying to promote risk analysis. It's important to know when to get out, when to admit you're wrong, when the investment case is not going to plan. And I have to be honest with you, everything's not rosy. It never is in any stock that you're going to own. So what's the bear case? Things can go wrong. First, data center growth. It's exciting, but it needs context. As I said, data center revenue is expected to double this year. What happens if it don't? What happens if growth just normalizes? Management teams from all over the AI space have flagged up that we've had exceptional growth this year, particularly from customers scrambling to secure capacity ahead of their competitors. This may not repeat at the same level next year. And then there's medical. It's already had a softer year, worth watching. Second, the stock has had a big run. It's up 140% from its 52-week lows. And if you're chasing this week's green candle, you could already be too late to the party. And what about Capital Markets Day? It's a risk as much as it is a catalyst. The market has already started pricing ambitious new targets. If the numbers disappoint or management sounds cautious, especially around data centers, you could easily give back today's gains and then some. Buy the rumour, sell the news is very real. What about margins? Margins are still relatively thin. Net profit margin is around 5%. For a manufacturer of this complexity, operating across 25 countries, that doesn't leave much room for error. If margins or volumes drop and then there's a main market, what happens if it doesn't happen? The move isn't guaranteed, it's under consideration from shareholders. If it doesn't happen or it gets delayed, again, another bullish catalyst disappears. And then, yes, there's the Iran war and tariffs and America and Trump, and all these are very unpredictable. As I said before, Volex's management team has done well in the past of navigating the company through these headwinds, but there's always that risk that this time is different. So, is the stock extended? Yes, it's had a serious run. I'm not going to pretend otherwise. But I don't think the story is over. A forward PE of around 15 times for a business growing organically at 13%, plus a return on capital employed of 20%, a CEO with over 25% skin in the game, a data center tailwind and years of runway, a potential re-rating from moving to the main market. I don't think this is an expensive stock. I think it's fairly valued, but it's still got some upside. Volex is still a name stock. It doesn't turn up in hot tips on social media. Most retail investors who are chasing the AI exposure are still buying Nvidia and Mag 7. They haven't clocked that a 130-year-old British cable manufacturer is one of the quiet picks and shovels in this AI build-out. It's sitting on a market cap of £900 million. And when the crowd wakes up, and I think they will, especially post Capital Markets Day, the re-rating could be meaningful. Look, I've been around long enough in this market to get burned by the hype, and I've learned to value the boring stuff. I watch companies that just keep delivering, management teams that do what they say, businesses with structural tailwinds rather than the narrative ones. Volex ticks all the boxes for me. It's not a get-rich-quick story, it never has been, but it's a keep getting rich slowly story. I'm prepared to have it in my ISA and left to run. It's in a sector that is only getting bigger. The future is electric, and it's digital, it's AI, and it all runs on cables. Volex makes those cables. So I'm going to be watching that Capital Markets Day very closely, and if new targets are as ambitious as I think they will be, there could be another leg up here. As always, this isn't financial advice. Maybe I don't even know what I'm doing. Make some money, but could be luck. No, I know what I'm doing. Listen, do your own research. I'm just some bloke following the markets. If you found this useful, give me a like, give me a subscribe, and drop a comment and tell me how shit it is. And I'll see you in next one, and we'll work on a watch list together. Get those ideas researched.